Hi, everyone. Welcome to Investor 360. I'm glad to see all of you here, and I hope you're all staying healthy and sane. These are strange times, but I want to talk a little bit about our firm. Stubbs Alderton and Marklees is a full-service law firm, really dedicated to supporting entrepreneurs and innovators in fast growth companies. We have a diverse practice of corporate securities, mergers and acquisitions. I run our intellectual property and technology transactions practice. I like to say that we are former big firm partners, but we're a firm of big firm capabilities without being a big firm with expensive rates and a lot of the bureaucracy that big firms have, with the high touch and personal attention that a smaller firm can provide. One of the unusual things about our firm is that we started the Preccelerator, which is and maybe I'll have somebody else who is involved in operating it talk about it, but it's a co-working space and incubator accelerator that our firm started years ago, which is unusual for a law firm. And it's, again, sort of our way of supporting the entrepreneur community in Southern California. Great to have you all here, and I look forward to talking with you more a little bit later in the program.
Absolutely. Lynn, did you want to just give, to piggyback on that, do you want to give a little bit of information on the Preccelerator? We can't hear you.
You're on mute.
There you go.
I thought I clicked it. I owe myself 50 cents. Good afternoon, everybody. It's good to see you all. Michael, thank you for agreeing to do this today. We're excited to hear from you. I'm Len Lonzi. I'm the managing director of the Preccelerator program. We are a program by the law firm, and we are located on the promenade here in Santa Monica. We're open, and we have about 5,000 square feet of co-working space. We have a mentor network. We do workshops. We have meetings with our cohort founders, and we have practice pitches. We have a really full-blown syllabus for our cohort companies. You can apply to the accelerator online if you're interested to find out more information. I don't want to go into a lot of detail here. I'll put it in chat so you can look at it. And if anybody has questions, feel free to email me. My email is located on the website. Thank you.
Awesome. And then Anna from TriNet.
Thanks, Heidi. Hi, everyone. My name is Anna Evans, and I'm with TriNet. Thank you all for joining the meeting today. We're excited to have you here. So what TriNet does is we really work with early stage startups to help them with all things human resources. So I know as a founder, you're probably dealing with, wearing 1,000 hats, trying to fundraise, trying to attract top talent, build your product, all of that kind of good stuff. And so what TriNet does is we help you offload all of the pieces around your employee management that you really don't want to spend time on. So help you with benefits, with HR compliance, with payroll, with workers' comp, so that you guys can really focus on the other aspects of your business that are going to help you grow and create revenue. We've worked with companies here in LA like Snap, Dollar Shave Club, Netflix, just to name a few. So would love to get the chance to learn more about what you guys are building and enjoy today. Thank you.
Thank you, Anna. I don't see that we have anybody from the other partners, so I'll give brief introductions for the other partners as well. So we partner with Silicon Valley Bank, and I know many of you guys were invited here today by SVB. They are a full-service startup technology bank specializing in everything technology as well as healthcare tech. And they do general business banking. They have venture debt services and other investment services, and a ton of other resources to help startup companies along their evolutionary journey. So we thank them for partnering with us and for inviting a lot of you. We also have Early Growth Financial, who has partnered with us for a lot of years, and they are everything you need for your accounting and senior accountant and CFO needs. as well as CMO-LA, which is Peter Mansfield. And if you don't know Peter, he is one of the most well-connected people I know in Los Angeles. Really great guy who will help you with everything for strategic advice for marketing. He has a specific interest and specialty in fintech. So if you're a fintech company, he's the guy to know. So I don't want to take any more time away from our presentation today. So I'll give you a little bit of background. We've done these for, I guess, about the last almost 8 years. And we had you fill out some information when you registered for the event, and that information was passed along to Michael Tam so that he'd have background on who is attending today. And so if your company is within his vertical, you can reach out to us and we can make that warm intro for you, or reach out to one of the other partners to make that warm intro. So typically if we were in person, you would get that chance to make an introduction. So we've done that in lieu of that. If you have questions, make sure you put them in the chat function on Zoom, and we'll go through those at the end of the fireside chat. And I guess to kick things off, Michael, will you give a quick introduction to yourself and a little bit about yourself, and then Kevin will jump in with the Q&A.
Yeah, hi everyone. Can you hear me okay?
Yep.
I always get internet unstable sometimes, which is the worst thing for Zoom. So yeah, thanks for taking the time, everybody. Thanks for having me. I'm, as everybody knows, I'm at Craft. I've been there I've been there 2 years now. Based in LA. Prior to Craft, I was at another LA early stage fund called Crosscut. We're seed focused. There for a couple of years. Prior to that, I was at Uber for a few years in the SoCal office, running a few regions, and launched a financing product. And then prior to that, business school, investment banking. Had a startup actually prior to business school that was acquired by Procter & Gamble. Yeah, that's kind of the quick high level. And I can go into more detail at what I cover at Craft as well.
Okay. Go ahead, Michael. I'm sorry.
Sure. Yeah. So Craft. Let's see. We're investing out of our second vehicle. It's a little over 500 million. That started Q2 of last year. Fund 3 will likely be early mid next year. Fund 1 was 350. That was Q4 of 2017. The fund is pretty generalist. If you look at the portfolio online, kind of all over the place. We led the A of Bird, which is electric scooters. We co-led the A of Cloud9, which is an esports team. Early in cloud kitchens, late in boring companies, SpaceX and Reddit. But the sweet spot, or the areas of interest for us, are predominantly in B2B SaaS and marketplaces, so ARR and GMV driven business models. And the minority of the portfolio is going to be transactional business models, fintech, et cetera. So the portfolio companies I work with are both B2B and B2C, and both B2B SaaS and marketplaces. And that's where I spend most of my time. I have an affinity for marketplaces, and we have an interest in vertically focused labor marketplaces, which I can unpack later in the conversation, but that's the quick high level of the sector coverage. Stage-wise, I would say C to B is where we cover. So typically leading A's, B's, we could follow as well. Pre-series A, we're not as ownership sensitive. So check size could be a few $100,000, it could be $1 million, it could be $2 million, it could be upwards of 20 million, depending on the round. So I'll stop there, but can definitely go into more detail.
Great. Thanks, Michael. It's great to meet you, and I'm glad to have you here so that we can learn about Craft Ventures. I just want to say that, while we're all working from home, life goes on, and innovators continue to innovate, entrepreneurs continue to disrupt established industries, and investors like you continue to invest in new ventures. So it's all great to see that, this is continuing. One data point that I could share is, our firm, our corporate transactions practice is really active right now. It's probably the busiest in doing several financings and sell-side M&A deals that we've been in several years. So, while we're all working from home, deals continue to get done. So, and that's why we're all here, to find out about Craft Ventures and to actually give, people in the audience an opportunity to understand how to engage with you and with Craft if it seems like it's a good fit. So maybe along those lines, Michael, one thing I'm interested in knowing about is what do you in particular look for in a startup? If it fits within the profile that you said, B2B SaaS, C2B, marketplaces, check size could be small to anything beyond that. But in particular, what do you look for in terms of a team, maybe the competitive space that they operated in? What are some of the things that kind of catch your attention?
Yeah, there's a lot there. So I would say the lowest common denominator is post-revenue, post-product, especially these days. Prior to COVID, we may have gone a little bit earlier in terms of seed, even pre-seed, but in terms of the risk profile, we tend to stray toward post-product, post-revenue. Things that catch our attention, are not dissimilar to other funds, I think. Momentum, top line, compounded monthly growth rate, for example, is a quick first filter we use. 11% for 12 months is effectively a 3x year over year, 200% growth year over year, and so that's something that we like to use as a quick gut check on how things are going from a revenue standpoint. We'll look at gross margins, and if it's a B2B SaaS company, and also for marketplaces, we focus on revenue retention. For monthly cohorts, we focus a little bit more on revenue retention over logo retention. We like to see, cohorts pay, let's say 110 and greater % on a revenue retention basis. And so those are the quantitative filters that we use initially. Qualitatively, it really varies by the market and the business model. We have a strong affinity for B2B SaaS with a sales motion, given David Sachs, one of the founders of the fund, started a company called Yammer, and it was kind of one of the first companies that started the consumerization of enterprise. And there was I think a freemium version that employees could sign up for, and then they use that to drive the top-down sales motion. And so we are starting to really focus, especially during Fund 2, on B2B SaaS with bottom-up adoption. So what does that mean? Something that doesn't really require a demo to be booked, for example. If you're on the website, you can sign up, submit your credit card, have a free trial for 2 weeks, or freemium version of the product. And anything that we think qualitatively and the product reflects some reduction of friction of adoption for the customers is always something that we qualitatively pay attention to. And so the bottom up go-to-market is a manifestation of that. Marketplaces, like everybody else sort of has talked about online, fragmented markets. I like marketplaces where supply and demand are interchangeable, because that just helps drive liquidity. You have, rather than a one-to-one transaction, you have many-to-many, essentially, that increases the need for a marketplace to insert itself into the transaction, poor status quo on both sides, managing the payment. So, there's a multitude of characteristics that we look for when it comes to the business model and the market. In terms of the team, it's pretty much like unique domain expertise, some unique insight, previous work experience that is relevant to the ability to manifest the vision that they have, and then a reconciliation of that vision to the metrics, essentially. So that's kind of a ramble there, but that's like a high level of what catches our attention.
No, that's good information. Thank you for that. Clearly, if you're post revenue, post, product launch, initial product, you're not the first money in. So I guess what I'm interested in knowing is, the companies that perhaps you've invested in, during the pandemic, let's say, this year, where have those companies raised their pre-seed rounds? Are they bootstrapped? I'm sure it's a mix of a lot of things, but what are you seeing out there? Angel investments, safe convertible notes, that sort of thing. How what is sort of the portfolio been that you've encountered in prior raises?
In terms of where we source and sources of potential.
Not necessarily where you source, but when they come to you and they've capitalized the company to develop the product and get it to a place where they're ready for craft ventures, where have they raised their money before? And I guess, a follow-on question to that is there any kind of way of raising money that would cause you concern, such as crowdfunding versus or a strategic, or are you agnostic as to what you're building on top of in terms of the cap table?
Yeah, I think we're pretty agnostic. It's never really come up as a topic during diligence of who the prior investor was. I think in terms of the financing history, the discussion usually is more around capital efficiency. Mm-hmm. If they've raised 10 million, for example, and the pre-revenue, it's a hard, point to stomach in terms of like, how do we connect the historical performance to going forward? Now, if they've been bootstrapped and have been capital efficient and they've hit, I don't know, 500K ARR, a million ARR, like we've seen companies that have bootstrapped for 5 years and are at 5-6 million ARR. And that's, it's obviously very difficult and very impressive. And so I think we look at financing history more from an efficiency standpoint rather than the form of that capital. And it's kind of all over the place, to your point. It could be angels, it could be family and friends, it could be traditional seed funds where we have relationships, it could be accelerators, it could be bootstrapped. So it kind of runs the gamut, but the thing we look at the most is capital efficiency.
Mm-hmm. And to that point, do you, at what point do you like to be brought into the process? For example, is it too early for a company to meet with you, even if they're not ready to take money from Craft Ventures because they're not at the place that you described? But nevertheless, they want to sort of start cultivating a relationship when they are at that point to raise money from you, 6 months down the road, for example.
Yeah, definitely. Actually, before I answer that, I was going to close off the last point on capital efficiency. Yeah. My GP, David Sachs, has written a Medium post on the burn multiple, which is worth checking out. And it's just an inversion of the of Bessemer's. Bessemer has some sort of SaaS metric, but all it is net new ARR divided by the burn. And we use that as a quantitative metric to measure capital efficiency. But to answer your question, I mean, I think it varies by the individual on the investment team. I have a preference for meeting folks, prior to a process, because I mean, the founders should get to know us just as much as we're getting to know them. And so the more touch points, the better, in my opinion. Obviously, there's a trade-off just in terms of the amount of time spent and needing to get back to working on the business itself, which is the most important. So, it's a sort of a song and dance, and it really just depends on the founder's preferences, is what I always defer to. But, if founders are interested in chatting prior to an actual fundraise, I always have that. I always have a soft spot for that, just because I know the process is pretty opaque.
Mm-hmm. Great. Maybe you could talk a little bit about the process once you are sort of engaged with a team, with a company that you're evaluating. What is the process on your end to socialize it internally? How long typically does that process take? What sort of insights would be helpful for entrepreneurs to know about that process?
Yeah, so I always describe our process as more ad hoc and structured. We don't have a final investment committee meeting where the founders and the teams are meeting the entire craft team at one time. That you frankly never meet the whole craft team ever as a group. It's more driven by the founder's interest and therefore availability to respond to our questions during the diligence process. If there is one kind of consistent thing that we do, which is why it's kind of tagged to the fact of our interest in post revenue is we have a data exercise that we do, which is really just asking for the historical monthly P&L, and then looking at asking the founders for customer monthly spend. You know, if it's a B2B SaaS company, then it's just each individual customer's MRR essentially. And that allows us to extrapolate and normalize what revenue retention is per monthly cohort, payback periods historically on a contribution margin basis, what gross margins have been like, sales and marketing efficiency, the capital efficiency, the burn multiple that I mentioned earlier, logo retention, and that's usually the first step that we take after meeting. Taking a step back, what usually happens is like anybody on the investment team, GP to associate, will have the first meeting, their respective first meeting. We use Yammer internally to talk about opportunities and everything else internally. The company David started, so that allows us to operate asynchronously. We don't ever wait until Monday to talk about opportunities, which is when the whole team convenes. So we'll discuss things online. There'll be some discussion. Maybe some folks have looked at some companies. We'll have a follow-up meeting with a partner, and from there we'll run the data exercise. And if the metrics sort of align with our areas of interest for that space, then we'll, I think our process is not too unique. Demo, customer references toward the tail end, competitive landscape, just ad hoc questions with the founders. So it's really predominantly driven more by the founders' availability to respond to those questions.
Mm-hmm. That makes sense. While we're on the topic of process, I'm going to interrupt sort of the flow to take a question from Satish. Hopefully I pronounced his name correctly, because he asks, in terms of the timing on a first touch with Craft Ventures, would it be a good idea to initiate a conversation of a well-baked idea stage company with a pitch deck that is approaching angels, or would you say that's just way too early and maybe to hold off until they've, have more of like, let's say an alpha or beta version of the product? What is your sense of that, Michael?
Yeah, good question. It's a question I'm thinking through real time. Just there's only so many hours in the day I want to meet sort of everybody, and whenever they would like to meet, it's just challenging. So I would say if it's at an idea stage, and it's tough to figure out if it's at the idea stage, it might be early to meet, although I'm still happy to have that conversation. It's just not going to be very actionable from Craft's perspective. But it is still, and I have a lot of friends who are angels and folks we've co-invested with. And so that always turns out to be the case where if they're early for us, we help facilitate intros to folks who might be more suitable for the round. So net, it's always still worth chatting. And it's just driven more by whether it's going to be worthwhile for the founder's time.
Mm-hmm. Makes sense. Thank you. Kind of related to that is, and you kind of alluded to this earlier, so I want to come back to it, is in terms of where you find companies, where you source your deals from. I know that you're based in, or Craft Ventures is based in San Francisco, has offices here in LA and New York. Do you primarily invest in companies that are based in those locations? Although these days, who knows where people are based, where companies are based. But where do you source your companies or opportunities from? And kind of a related point to that is, what differences do you see in terms of where the companies are coming from?
So we definitely don't have a geo focus, although I'd say outside of Canada, US, and maybe Mexico, it gets a little bit tougher. We started to look in Europe, but it's a very rare for instance if we get to an investment decision. But in the States, we're pretty agnostic, and in Canada, I would say we've invested in companies based in, actually, especially during shelter in place or COVID, San Diego, DC, Vancouver, Boston, and New York. we don't have an affinity for location Utah. And the differences in the ecosystems, it's a good question. I don't know if I have enough data points to really speak to it in a confident manner. We have a portfolio company in Utah that has a lot of former Qualtrics early employees, and they have a really good sort of SaaS sales culture and operational approach. And so I've noticed a good amount of B2B, and we've looked at a good amount of B2B SaaS companies coming out of Utah, maybe because of the ecosystem they've built. But we don't, I think we have a company in Atlanta, and it's not as systematic. It's really just the relationships we have, with upstream, earlier stage investors, portfolio founders. Now, if, we have founders we've invested and partnered with in Utah, Boston, Atlanta, they're going to be great sort of ambassadors for us too, because they're active participants in the ecosystem, and they have recommendations for founders they work with or companies they're customers of. And so those are always welcomed introductions as well. So I don't know if I have an articulate observation of among the ecosystems. We're really just interested in high accelerating companies.
Yep, that completely makes sense. And, I guess given the pandemic and that we're all working from home and communicating through Zoom and other platforms, it really enhances the ability of ecosystems or companies in different ecosystems throughout the country to access venture funds like yours. So there's sort of an interesting positive to all of this. And I'm curious to see how your approach to investing or Craft's approach to investing has changed during the pandemic. And I'm not talking about, we're doing Zoom calls, that's obvious. But, for example, I meet with entrepreneurs all the time, and I met with a team that was developing a new type of hand sanitizer. And, my response was, oh, that's very cool, but what are you going to do after the pandemic? What kind of business are you going to have? So I guess I'm curious, what are you seeing, if anything, that's different these days, and how sustainable is that different way of, that different kind of solution going to be? If that makes sense.
Yeah. So, especially now, to your point, a lot of businesses were accelerated significantly or decelerated. So the initial question definitely tends to be, is this a flash in the pan, or is this a sort of sustainable momentum post vaccine, whenever that happens? And so that's a question we definitely use and have used or have debated since April. And some of the trends are trends that we're seeing that we think are sustainable. E-commerce, everyone talks about the acceleration of e-com. We have a company in Utah as a e-com enablement shipping insurance company focused on building a B2C experience in post-purchase. And they've really benefited from COVID, and we think are seeing some sustainable tailwinds. A company that I work closely with called Chef.com with an S, that's benefiting. We invested before COVID, but they sort of help empower economic earning opportunity for cooks. And as a result, with a lot of cooks being furloughed or restaurants shutting down, they're seeing it's a marketplace, so they're seeing a lot of interest on the supply side. So food, I guess, food tech, we think, I personally think, and we've discussed this internally, whatever can be delivered will be delivered coming out of COVID. And we're starting to see that obviously with grocery. And I haven't been to a grocery store since March. All I use is Instacart, and got my parents who aren't tech savvy on Instacart, which I never thought would be possible. And so I've been interested in like the supply side of distribution for these old school type of brick and mortar businesses, trying to find something at food service distribution or software catering to grocers, for example. because I do think that that's not, not reverting back to what it was prior to COVID. Ed tech, we spent some time in as well, and everyone sort of debates this question of whether folks are going back to the office just like they were prior to COVID, and I don't know if we believe that either. And so I've been looking at companies that are helping augment or benefit from that kind of remote hybrid world. So that is a constant question that we have to ask ourselves. Is this a flash in the pan or sustainable? And that's something we try to glean from customer conversations, from our own experience, from the context that we have from portfolio companies and other investments that we've assessed. I don't know if I have the right answer. Obviously, it's always a work in progress, but that's definitely an ongoing topic.
Yep. Yeah. No, those are good thoughts. Very interesting. So let's talk a little bit about, the way that Craft, and you in particular, engage with your portfolio companies. So investment is made, I suppose, depending on deal size and the type, will dictate the type of round it is, whether it's a priced round, or I assume for smaller rounds you do convertible instruments. Do you take a board seat in those priced rounds? How do you guys, I guess, assist, support, facilitate the companies and the team's execution of their business plan?
So I guess it depends on the stage of the company. If it's pre-Series A, we don't necessarily take a board seat. We'll have informal board, check-ins, whether it be every other month or quarterly, depending on the founder. Once it gets to Series A, then we'll sort of establish a board with the founders. We've invested on both notes and priced rounds. In terms of notes, usually, actually most, in my experience so far, we pretty much only use the YC post-money cap safe, which is just the template that we download from YC's website. We'll do a side letter for pro rata, which is, again, the same template that YC has on the website. And so we usually do that pre-Series A. It just helps the founder. The founder just doesn't want to go through legal due diligence nor spend the money on fees. And so that's pretty consistent for us in terms of the format of the fundraise. And then, Series A and B, we price those rounds, establish a board, and do what most funds who lead those rounds do. In terms of how we support the team and the portfolio companies after investment, I describe it as playing the metaphorical chessboard. That there's so much random and ambiguous, unpredictable thing. There's so many of those things that come up that it's the thing I didn't mention earlier. Everyone at Craft is either a former founder or operator or both, and that's kind of what you get with the team. The GPs have all started unicorn companies: StubHub, PayPal, Yammer, Remark, Social Concepts, and then we have a venture partner that started Boingo, Earthlink, and Cloud Kitchens. And so you get that lens as a founding CEO, having been through scaling a team, hiring a team, figuring out, should you go free trial versus freemium, and when, should your go-to-market be predominantly direct sales or mix of that and channel partnerships, and why, structuring the pricing, should it be tiered based on usage or seats, how to build liquidity in the marketplace, how to incentivize supply and demand to stay on. It's just everything and anything that the founder is interested in discussing with their investors. We're game. This beyond the GPs, the rest of the investment team. I came from Uber. I have colleagues who were at Reddit and Zenefits and Clearbit, Brex, Build, Zoom, Gainsight. So we kind of run the gamut in terms of function and industry, such that if there is a question that comes up, any question, product and hiring, etc., there's either someone on the investment team or someone in our world who we can definitely provide as a resource for our founders. So it's really not that it's not that formulaic. It really just depends on what the founder is dealing with as a priority at that moment in time, and we sort of swarm it in terms of support.
So it sounds like if you are the lead within the fund with respect to a portfolio company, and you're the principal contact, you all work as a very integrated team for whatever things come up with respect to that company. So it may be contacts or skills or assistance that other of your partners may have that you can tap into.
Yeah, and correct. Yeah, it definitely is circumstantial. You can't predict what's going to come up, but the nice thing is that the team has all been through a variety of sort of ups and downs, and so at the very least we can point to direct firsthand experience or find somebody in our world who has.
Great. In terms of like the Series A rounds that you've done, do you typically lead that round? And if so, will you syndicate or get other funds involved to participate, or will you typically take the entire round? Is it just ad hoc based on the circumstances?
More often than not, we're leading Series A's.
Mm-hmm.
If there's an opportunity to follow for whatever reason, like we met the founder after they signed a term sheet and there's only allocation for a follow-on track, that doesn't mean it's an immediate no for us. We have looked at follow-on opportunities with the idea to potentially preempt the B. So that's the nice thing with Craft is you have some optionality both as a founder and as a co-investor with other funds. So we can definitely co-invest, follow on. The default preference though is to lead a Series A.
Mm-hmm. Great. Can you, I know this is probably a hard one, but I know that founders often like to hear what others have gone through, both from, a success story standpoint, as well as, what sort of nightmare to avoid. Can you share an example maybe of each without naming names of, a company that just really nailed it, that, was a great fit? It doesn't have to have been sort of an end to that story in terms of a liquidity event, but just how, just sort of the dream type of company from Craft Ventures standpoint, and then perhaps an example of the opposite, sort of a nightmare story.
Yeah, let's see. So on the dream side, it's an easier question to answer, so I'll go to that first. So Chef, the company I mentioned earlier, we led the seed out of YC April last year. And what more context on the company? It's a marketplace for in-home, for cooks to use their kitchens at home. There's some regulatory tailwinds in California. It's called AB 626 that allows kitchens to be used as micro enterprises. We also saw, and Craft was an investor in Cloud Kitchens before I joined, but they saw the sort of rise of ghost kitchens and commissary kitchens being used both for like existing brands like Sweetgreens, but also virtual brands that are delivery only. So that's sort of a tailwind in the industry for Chef. I grew up, with my mom getting dumplings from friends, like exchanging food, and which may not be the mainstream kind of behavior, but that still today is happening. And to my knowledge, and especially in like immigrant type of communities and Indian American, Chinese American communities on WhatsApp and WeChat, still happens today. With my mom trying to give me a lot of food that she gets from her friends, I have no idea where it comes from. So that personal anecdote resonated, or was one of the reasons why Chef resonated early on, and so we led the seed. And consumer, what I learned from being at Craft and other folks in this world also, I think, share the same sentiment, is consumer is hard. It's sort of lightning in a bottle. You have to have just part luck, part just executional, optimal execution, and Chef, we liked the marketplace approach. Anyway, so all that said, we led the seed. There's an opportunity to double down earlier this year, right at the beginning of COVID, which I don't think we really had we didn't really know in March or early April which way things were going, but ultimately doubled down on Chef March, April. and they've benefited. They were growing before that. They've now accelerated that growth, given the tailwinds, as I alluded to earlier. And it's one that I'm very excited about. It's one that I'm personally hopeful for, that will bring more earnings opportunities to folks who need it. And you know, I can get good food from my neighbor hopefully in the future. So that's one that I think is a good story to share. One that may not be as favorable. So without calling out the company, I know that, I mean, and this isn't unique to the company. This is something that I think most founders and companies deal with. But you know, there's always struggles with, especially as companies scale, there's always struggles with senior folks and scaling that team and maintaining the culture of like, you know, go hard and especially now with everybody being remote. And so it's an ongoing conversation when you have to figure out, like, okay, now how do you slot this executive who was there from day one, maybe even a co-founder, and they're overseeing a team and it may not be working out the way you want it to, given the stage that they're at right now. How do you structure the team? How do you have those tough conversations at a board level amongst the executives? And that's really where, that's a perfect example of where the experience of the team, especially the GPs who have been in those situations before, can point to what they did at their companies in terms of, okay, well, you can, you know, give them a certain title and have them work within this realm, this function. This is how you approach that conversation. This is how you can, you know, just like guiding the CEO on. It's a sensitive and sticky, you know, conversation to have, and so I think it's helpful to point to stories where it's worked out successfully, and I think the founders appreciate that especially from the GPs who have navigated those kinds of tough situations that aren't unique. A lot of companies face that, but it's definitely one that we've experienced with our founders.
Yeah, those are both great examples, and that latter one comes up all the time, and it's terrific that you have folks on board who have had those awkward conversations and can provide, you know, the benefit of their experience to a company to navigate those waters. Very interesting and helpful. One of the benefits of being a moderator is I get to ask any question I want, and including questions that maybe other moderators might not, but because I want to know the answer, I get to ask them. I alluded to earlier, I didn't really give a full bio, but I run our intellectual property and technology transactions practice. I'm a hybrid of a corporate lawyer and an IP lawyer. And a lot of times I have startup founders come to me and, you know, out of concern about the fact that they don't have a solid intellectual property portfolio. And so, Michael, I want to ask you, you know, as an investor looking at a company at the stage that is ready for an investment by Craft Ventures, how important is intellectual property in your mind for a company to have locked down?
Admittedly, it's especially at the stage we're at. I don't know if it's a consistent topic we run into, nor is it our expertise. So it may not be something that founders are really coming to us often.
Or a concern that you wouldn't necessarily be.
Yeah, we wouldn't be the domain expert in that arena. I mean, I certainly have seen it as a pillar of the moat, but it's not something that I think we can really effectively support given our backgrounds. Yeah, I don't have a lot of experience with IP.
Mm-hmm. Yeah, that's fair. Before we go to Q&A, I just want to maybe give you an open-ended opportunity to, you know, is there any advice that you would offer to an entrepreneur that is approaching sort of maybe doing a pre-seed round at this point, but at some point down the road would be ready for having Craft Ventures look at them as a potential investment opportunity? Anything in an early stage that you could offer to that team or that entrepreneur?
It's a, yeah, I always am hesitant to frame what I offer as advice because it's so personal to the business. You know, from our, look, we're one fund, it's one data point. There's so many other investors. That's why you have to have those conversations, figure out who the right fit is for you and your company and your co-founders. I don't think there's one right answer. In terms of what we look for, and if you're at pre-seed, you know, the themes that we like, again, are sort of, I go back to like, every investor has talked about the proliferation of SaaS, and these, you know, these large public SaaS companies are becoming larger and larger, and what may look like a niche, so to speak, today is only going to become, in our opinion, much larger markets in and of themselves. Companies are becoming customers of their of each other. So for us, it's really just what catches our attention is the bottom-up adoption. I kind of go back to that, but it's what trickles down from that are so many other benefits that we appreciate and like to see in the business. And what I mean by that is, you know, with the bottom-up adoption, you have less reliance on paid acquisition. Your sales cycle is not as long. You have engagement data and conversion data that we can mess around with if it's not yet post-revenue. You know, we can look at DAU/MAU, we can look at weekly active over monthly active to better extrapolate the stickiness and the value prop of the product, even if you're not yet, you know, charging money for it. We're also very product oriented. We like to see like wedges in the product that are easy to adopt and are effectively your Trojan horse into expanding your ACV with your customer, which goes back to the earlier point around wanting to see greater than 100% revenue retention. So if I were to leave this conversation with one thing, it's that.
Hey, Michael, sorry, can I jump in on that question? You mentioned that before. I don't understand what that means. So 100% revenue retention of what exactly? Are you comparing that to marketing payback? Like, I'm not sure I understand the inputs for that calculation.
Yeah. So the math is, let's say you have 2 customers start with you January 2020. They're paying for, you know, for ease of example, they're paying you $50 each, you know, per month. And they're paying you monthly. So in month 1 or month 0, it's at 100%, right? Revenue retention, because you're just dividing that 150 times 2 divided by 50 times 2. Now let's say they, one of them churns in the 2nd month. Now it's 50, right? Because you kept 1 customer divided by the 100. And now your revenue retention in month 1 is 50% for that monthly cohort. And then in March, let's say you lose that 2nd customer, and now you're at $0 out of over that 100. And so now you're at 0% revenue retention. Now you can go the other way, which is why I've been interested in the opportunity to increase ACV. And you start off 100 over 100 in month 1. In February 2020, one of them doubles their monthly MRR with you. So now you're at 150 divided by 100 and so on and so forth. And that's what that formula that I'm using to get to that percentage of revenue retention.
Got it.
And we do that for every monthly cohort. So then
so just to make sure I totally understand, it's a combination of customer retention and upsell, basically.
Correct. Yeah.
Yeah.
We put less weight onto, like, we can at month 12, for example, we're okay if 80% of your customers, your individual logos are retained, right? If that existing 80% of the cohort is spending, 120% of the original revenue that they started off with you. And we do this, by the way, like for every cohort. So we take a weighted average across each of their monthly cohorts over time. So that's what I mean. That's the input, essentially.
Got it. Okay, that makes a ton of sense. But I was missing the upsell piece. Thank you.
Yeah. So that's also, again, going back to the original point, that's also an effect of our interest in bottom-up adoption, because bottom-up adoption can start off with 1 seat. It can start off with 1 feature. and then all of a sudden, you know, the product resonates so nicely with the customer that they're either referring it internally, they're expanding the usage with the product, and so they're increasing the ACV, the annual contract value of using your product, and we'll be able to see that over time, and that's what catches our attention early on. So that's a trickle-down effect. That's an example of what I mean by an output of that interest in bottom-up adoption.
So we're going to go to Q&A, and Phil Weinstein posted a question in the chat. Phil, do you want to just go off mute, and because it's kind of a long question, why don't you just say it yourself? Are you able to go off mute? Or I can read it.
There we go. No, I got it.
There we go.
Hey, Michael, how you doing?
Hi.
Hi. It's a real basic question, like how the business of a venture firm works. So, for example, you have a big pile of money that's put in by, in your case, it's your general partners, I guess. They're the ones that put the 500 million in, or whatever you mentioned.
It's actually not. Well, there is a certain percentage committed by the GP, by the general partners, but it's actually mostly institutional. So we have our own partner base, endowments.
So then how much of that money is used to run the business, to run Craft? And then what are those, so how much of that fund, you know, obviously you need some of that to pay the rent and pay you and everybody else.
Generally 2%, right?
That's right. Yeah, the standard is 2 and 20, 2% for every year of the AUM for fees, operational expenses, and then 20% is the carry that you split with your LPs.
Oh, that's great. So then what's the expectation of the person putting the money in? Obviously, they want to do better than if they just put their money in the S&P 500. And what's the time frame? So obviously this is a riskier bet. And so what are they looking for from people like you when you're shopping for businesses to invest in?
So well, one, I want to caveat my response with we have a COO who manages most of our LP conversations. So don't quote me on this, but my understanding from talking to LPs is that they look at every fund like a portfolio. They literally look at like Craft Fund 1, Craft Fund 2, and that's made up by X number of portfolio companies. And the time frame, you know, it's 7 to 10 years in terms of like the payback essentially of when they get their liquidity. And, you know, maybe the S&P now is a bad example, but compared to the public market, like I think a 3X is my understanding. A 3X is a good top quartile of fund. The data is actually public. I think Greenspring is an LP that publishes some of the performance by vintage over time. And so you can see every vintage year fund's performance and the median, 75% quartile, et cetera, of that performance.
No, that's good. So obviously when you mentioned early on, you want to see businesses that are, they're doing well, they're making some money because your bosses obviously want to do well, and you're not going to present someone that's just way too risky, because that's not, you might like the idea, but you're like, well, this is not ready yet. It's not ready for me to show to people above me because it's not demonstrating in the market that it's making a lot of money yet.
I mean, I think you're hitting the nail on the head in terms of like what the job is. Like you kind of have to like thread the needle if it's not, you know, and that's why we focus on momentum, in my humble opinion, because that's a way to mitigate the risk. We avoid things that are pre-product because we just don't know yet how it's going to be received out in the wild. If it's growing 9x year over year, 10x year over year, that's a way to sort of mitigate that risk, that it's, you know, there's a willingness to pay there, and that you have a customer that will, you know, stick with you. And that's why we look at revenue. Like, so that's kind of the nature of the job, I think, is to be able to try to get to investment conviction that this is going to be a 10 to 100x multiple off of our cost base.
Okay. So then on the flip side, let's say you have a successful business and you've got lots of people coming at you wanting to give you money. So what's the upside to going with a venture firm versus, I don't know, a bank or something else?
Yeah, so I would, venture is there's so many forms of capital out there. I would definitely be certain before you take on venture capital that you understand what the trajectory of venture capital funding route is. Because the pace, I mean, successful business is, I think, a subjective phrase. There's so many successful businesses out there that that it's hard to sort of pinpoint, what the definition should be, other than the fact that, like, in venture, the growth is what matters, and we're looking for outcomes that are outlier outcomes.
Right.
So, Michael, I want to be respectful of your time. I know that we're at the 1 o'clock hour. Do you have a few more minutes to see if there are any other questions, or do you need to jump?
No, I got a few minutes.
Okay, so if anybody has any additional questions, you can put them in the chat, and then I'll call on you or I'll read it. Phil, I just wanted to, while we're waiting for that, say that, Mark Schuster once said that in a talk that I was at, that venture capital is rocket fuel. It's where you've sort of established that you have a business and a huge market opportunity ahead of you, and you're just putting gasoline on the fire. And so venture means that you're giving up a little bit of ownership, giving up a little bit of control. Obviously, a bank is not going to lend you $10 million unsecured with no assets. But to Michael's point, absolutely, there are different types of capital out there, different avenues for getting that funding, and they're not all suited for your particular circumstances, so they're worth investigating. There's a question here about, let's see, Michael, would you be willing to share your contact information in case we have any follow-up questions?
Yeah, I'm at michael@craftventures.com.
That's easy. Okay, then Fred asks, can you talk about supply and demand, the supply and demand model for Chef, and how the regional implications as the company grows?
Yeah.
Fred, do you want to elaborate on that, or
what do you mean by regional implications?
You're on mute, Fred.
Well, actually, I mean, the service of Chef, I saw that, I guess I'm prepping for the call yesterday or a couple of days ago, and it did intrigue me. So I did a little bit of research ahead of time. Then just now, as I went on to see if I could get something in my neighborhood in LA, my zip code is not served yet. So, I mean, so I'm assuming that you started in a specific regional market. And I guess what I'm trying to get a sense is what you're learning in terms of both supply of the chefs at the regional level and demand, right? It's not like the Uber model, there are drivers and cars everywhere, and there are people who need to get A to B. But I have to say, from the supply standpoint, the chef model is predicated on the supply of talented chefs. So that's why I'm just trying to get a sense as to what your thinking is on the growth trajectory by region.
Yeah, makes sense. So you're touching on an interesting point that I think is where the next sort of evolution of marketplaces could be. You saw Uber and Airbnb, for example, or maybe Uber and Bird might be like hyper local. Like, you need supply and demand to be onboarded in the same region to build liquidity for it to even work. And then you have Airbnb that's sort of geo-agnostic, and that they've benefited from having folks on board everywhere. Chef, definitely, I think what you can argue is more hyper-local. But then I also am a big believer in tech-enabled franchisee models. So what I mean by that, Bird, for example, the scooter company that we invested in, they have a platform model, essentially, that empowers local operators to run their own fleet of scooters. And essentially it becomes a SaaS business, because they take a licensing fee, and the operators lean on Bird to generate demand. They provide analytics, they provide more favorable economics on the supply. And Chef's not there yet, but I'm intrigued by that tech-enabled franchisee model as the next iteration of marketplaces, especially as we see more marketplaces skew toward B2B use cases rather than B2C use cases, and therefore you have more, you have folks who are managing their own business, you have on the supply side companies. And so you bring up a good point, though. I think more of these marketplaces that are operationally intensive and have hyper local dynamics need to figure out how to virtualize more to produce more favorable economics and scale faster.
I mean, but it's also an exciting story for like coming out of COVID. Chef has an opportunity to hold on to some of the market that they would be able to tap into globally, or certainly across the United States right now.
Yeah,
I mean,
and I would even, to one of your points, I would argue that talented cooks are everywhere.
Yeah.
Right, and there's the initial thesis on investing in Chef was that you were getting access to cuisine and food that you wouldn't get in restaurants. You know, it's my family's old recipe, for example, that just wouldn't go. So I think that unlocking of skill and in this case food is an interesting value prop.
So maybe a good question to end on is how best to contact you. And so the idea is, is a cold intro or outreach to you by email just as good as a warm intro. Our clients, many times they want us to make introductions to relationships that we have with venture capital investors, what we do. And so everybody's different. So like David Kremen will say, send me everything and I'll just decide what looks interesting. What I and many of my partners tend to do is sort of be very focused. Let's see what seems like a good fit with the venture funds or firms that we know, and then we'll make an intro on a case-by-case basis. So two really related questions, Michael. Cold intro versus warm intro, does it matter? And two, how do you like to proceed? Your time is limited. Do you like the filtered approach, or do you just like to see a lot of different things and you'll make the choice?
Yeah, it's case by case. Everyone's different. I always feel like an outsider, so I have an empathy for cold emails. It doesn't mean that it's always going to be a fit. Young daughter now, there are real trade-offs to saying yes to everything. But yeah, I would say, my emails, like I said, michael@craftventures.com. Shoot me a note. Can't guarantee that I'll get back to you within the time frame that you might like. And if you don't hear from me, definitely please follow up and I will. But I'm a fan of just, you never know until you shoot your shot. So I would definitely do that way. And other people may operate differently, and it's just personal style.
Mm-hmm. That makes sense. Unfortunately, Jason, we're not going to have time to get to your question, but you could I presume you could send Michael an email with the question if you want to do that. I want to take this opportunity, Michael, to thank you very much. It's been incredibly insightful. Really enjoyed having a conversation with you, and I'm glad that you were able to join us today. And with that, and I want to thank everybody else here who attended, working from home. Thanks for joining us, because without you, we wouldn't have an event. So great to see you all. Stay healthy. And I'm going to turn it over to Heidi to close out the event.
As Kevin said, thank you everybody for attending, and we hope to see you next month on December 16th for our next Investor 360. So you'll see emails about that. Stay tuned. And
just so you know, late breaking news, it's going to be a partner from Unshackled Ventures.
Excellent. All right, we'll see you then. Take care.
Thank you.
All right. Thanks, everyone.
Thanks, Michael.
Bye.
Bye.